So I changed the title slightly to be more representative of what the paper is. So the new title is, to what degree and through what channel do central banks other than the Federal Reserve cause spillovers? So I'm from the Federal Reserve Bank of Boston, and so I need to give the usual disclaimer that the views expressed in this paper are mine and do not necessarily reflect the views of the Federal Reserve Bank of Boston. So just to give a simple overview, so in this paper, and of course during this session, we're going to be talking about monetary policy spillovers. So by that I mean monetary policy, how monetary policy changes in one country can affect economic conditions in another. So to summarize what I believe are the existing views of the literature, I would say that the Federal Reserve is the primary source of spillovers and drives the financial, it's generally believed that the Federal Reserve is the primary source of spillovers and drives the global financial cycle. So that means that when the US tightens, it has a contractionary effect globally, and when the US expands, it has a global stimulatory effect. However, there's been limited attention paid to central banks elsewhere. So I think some papers have demonstrated that spillovers from the ECB may potentially cause spillovers, but there's been little analysis of other central banks. And I think in general, people believe that spillovers from other central banks are negligible or don't really exist. So one final thing that I would say the literature generally believes is that the Federal Reserve doesn't need to particularly worry about spillovers from other countries, although maybe it does need to pay attention to how spillovers from itself may spill back to itself by its impact on other countries. So this motivates my research questions that I will study in this paper. So first, I'm interested in to what degree do central banks other than the Federal Reserve cause spillovers? And then secondly, assuming they do, I wish to study which channel is, or what is the channels through which other central banks cause these spillovers? So my empirical approach is that I'm going to use a high-frequency identification. I'm going to look at how a monetary policy event in a source country affects interest rates in other countries using this high-frequency approach. I'm going to do this for a panel of 20 central banks, and I'm going to measure the degree of spillovers from each of these central banks. So my results are as follows. So I find that 14 non-Federal Reserve central banks show evidence of spillovers. So those central banks are from Australia, Canada, Switzerland, Czechia, Eurozone, UK, Japan, South Korea, Mexico, Norway, New Zealand, Poland, Romania, Sweden. And I'm going to show that these spillovers primarily affect medium and long-term bond interest rates in other similarly developed countries. I'm also going to show that they spill over to corporate bond interest rates. I'm going to show that in certain assets, these spillovers have very large impacts. So actually, for long-term bonds, I find that these other central banks account for 4/5 of spillovers, and the US only accounts for 1/5 of spillovers to long-term interest rates. So this contradicts the view that the spillovers from non-Federal Reserve central banks are not that important yet. It's on the next slide. Yeah. Okay, yeah. So the other thing that I will the other thing I will show is that actually these spillovers also affect the USA, which again kind of contradicts the view of the literature that spillovers don't really have that spillovers don't tend to really affect the Federal Reserve, and they're not something they need to worry about. So the second regarding my second research question. I'm also going to study how these spillovers occur through what channel. And my general argument is going to be that non-Federal Reserve central banks spill over primarily through a bond pricing channel. So by that, I mean that if a central bank lowers its interest rates, investors are going to look to invest in other similar bonds, and that's going to raise the price and lower the yield on other similar bonds. And so in particular, what they're going to do is they're going to say, okay, let's say the UK lowers its interest rate, they're going to say, investors are going to look instead to invest in other similar countries like the Eurozone or Australia or Canada. So this can explain features of non-Federal Reserve spillovers. So notably, this can explain the fact that these spillovers seem to be primarily coming through the term premium rather than the expected path of interest rates. Also, this can explain why these spillovers have a much greater impact at medium-term and long-term interest rates than short-term interest rates. And this can explain in general why these spillovers seem to primarily affect similar bonds in developed countries. So in contrast, the Federal Reserve spills over to a wider degree. So it actually spills over to short-term interest rates as well. It spills over to emerging markets, and it spills over to additional asset classes. And I argue that this is basically because the Federal Reserve spills over through other channels as well. So basically, while these non-Federal Reserve central banks have significant spillovers, they have a narrower impact. So in terms of the literature, I think the most important literature that I speak to are the papers that have looked at the degree of spillovers from non-Federal Reserve central banks. However, these papers tend to really just focus on spillovers from 4 central banks, the Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan. So the reason for the focus on these central banks is because these central banks have quite nice derivatives data. And so basically, people have focused on that. I'm using a slightly different source of data, which is why I'm able to look at a wider range of central banks. So another literature that I speak to is papers looking at the global financial cycle. But those papers tend to look really primarily at the Federal Reserve and its role in driving the global financial cycle. So my paper shows that maybe there could be an additional role for other central banks. And then finally, one additional literature I would point to is papers that look at the determinants of the size of spillovers that are received by other countries. So let's say, but these papers tend to focus just on if the Federal Reserve raises interest rates, how does this affect spillovers in other countries? And so basically, so my paper differs from this in that it's looking at the degree to which many different central banks, how does that impact, it looks at the determinants of the size of spillovers from many central banks rather than just the Federal Reserve. So now let me move to discuss in more detail my empirical approach. So as I mentioned already, I'm going to use a high-frequency identification approach. I'm going to look at a panel of 20 countries. So I'm going to have 10 developed. So that's Australia, Canada, Switzerland, the Eurozone, Great Britain, Japan, Norway, New Zealand, Sweden, USA. And by the way, I didn't determine which ones developed and emerging. I used the MSCI definition. Israel's a bit of an awkward one because they changed in 2010. I put them in emerging in this case. And then 10 emerging. So China, Czechia, Hungary, Israel, South Korea, Mexico, Poland, Romania, Russia, South Africa. So I'm going to measure the spillover from each country to the interest rates in each other country. So basically, I'm going to look at how interest rates change in one country. How does that affect interest rates in each other country, assuming that there is enough data existing on interest rates in the time window that I consider. I'm also going to measure the spillover from each country to the average interest rate in other developed or other emerging countries as well. So to do this empirical approach, I need high-frequency interest rate data for each country in my panel. So in particular, what I'm going to do is I'm going to look at a high-frequency window around monetary policy events in the source country. So let's say that there's a monetary policy event in the UK. I'm going to look at how interest rates change in the UK. And then I'm also going to look at how interest rates change in other countries at the same time. So I need interest rates on both the changes in both the recipient and the source country. I'm going to take this data from Refinitiv, which has nice historical interest rate data. I'm going to look at, and they have data available from 1996 onwards. So the second type of data that I need to do this is I need data on central bank events. So I'm going to need data on the date and time of monetary policy events for each central bank in my panel. I'm going to primarily compile these from Bloomberg, and there are 4,760 monetary policy events in my panel. So to give you more detail about the specification, I'm going to look at how the change in the interest rate I in the recipient country R, maturity M, at time T, is determined by the change in the interest rate in the source country S, the maturity M at time t. And I'm only running this regression when there are monetary policy events in source country S. So I'm going to use the high frequency window as I mentioned already. I'm going to look at primarily 1 hour before to 1 hour after the monetary policy events in source country S. However, you can also, I find similar results for a narrow panel of 20 minutes. Narrow window. I'm going to drop, since I'm looking at many different monetary policy events around the world, I'm going to have to drop monetary policy events that overlap with monetary policy events in other major countries. So now let me discuss my results, or give the first set of results. So what this table shows is these countries are the source countries. So basically, this column is looking at the impact of a change in the monetary policy events in Australia. This is looking at the change in a monetary policy event in Canada. And then in panel A, I'm looking at the change in short-term interest rates measured by the 6-month interest rate. Panel B, I'm looking at the change in medium-term interest rates measured by the 2-year interest rate. Panel C, I'm looking at the change in the long-term interest rates measured by the 10-year interest rate. So basically, if we look, say, at this number here, what it means is that if there's a 1 basis point rise in the Australian 10-year interest rate around a monetary policy event in Australia, then that is associated with a 0.14 basis point rise in other developed countries, not Australia, other developed countries, average 10-year interest rate. And when I say the developed average, basically I'm going to take whatever data is available for that, around that window where monetary policy events are happening in Australia. So basically a 0.14 percentage point rise. And this is significant at the 0.1 significance level. So then similarly, I do these regressions for every country. And basically, there's a few things that stand out from this table. So I think the first thing is that if we look at short-term interest rates measured by the 6-month interest rate, we don't see that many spillovers from non-Federal Reserve central banks. So there's only 3 central banks that cause significant spillovers to the short-term 6-month interest rates. So there's Great Britain, the ECB, and the USA. And the USA causes by far the largest short-term spillovers. Now, if we look at medium-term interest rates measured by the 2-year interest rate, we see more significant spillovers. So many countries do cause significant spillovers at the 2-year interest rate. However, if we move to the 10-year interest rates, or what I call long-term interest rates, we see the largest spillovers. And actually, for every country apart from the United States, there's an increase in the size of the spillovers at the 10-year maturity. And so we see in general that there seem to be significant spillovers to long-term interest rates for these developed countries. And these numbers are pretty significant and quite large in certain cases. So like all of the numbers with 3 stars have a significance level of less than 0.1%. And also we note that like this is the number for the USA, so this means that a 1 basis point rise in USA 10-year interest rates is associated with a 0.5 basis point rise in other developed countries in the same interest rate window, in the same high-frequency window. But that's actually smaller than for the Eurozone for long-term interest rates. Just make sure I said everything. Yeah. So we can also do this approach with emerging markets as well. So here I'm looking at the change in the impact of spillovers from emerging markets to developed countries. And so basically, I'm looking at the 10 different emerging markets in my panel, how 1 basis point rise in those emerging markets is associated with changes in interest rates in other countries, in developed countries. And so what we see is that there isn't any significant impact at the 6-month interest rate. There's not really any significant impact at the 2-year interest rate. However, for the 10-year interest rate, we do see, again, some significant impacts. So notably for Czechia, For Korea, South Korea, for Mexico, Poland, and for Romania, we see significant spillovers at the 10-year interest rate. So overall, we see that I find that 14 non-Federal Reserve central banks seem to show significant spillovers to long-term developed country interest rates, and 8 show spillovers to long-term interest rates with a p-value of less than 0.1%. So I'm just in the interest of time, I'm just going to summarize the results for emerging markets. So I find that there are limited spillovers from non-Federal Reserve developed and emerging central banks to average emerging interest rates. And actually, the only central bank that seems to cause significant spillovers to emerging markets is the Federal Reserve. So we can also, just as a very simple summary of what I just showed you, I also compute the spillover shares just by basically taking those coefficients, adding them up and dividing by 100. So basically, for short-term interest rates, I find that the US has by far the largest causes by far the largest share of spillovers, 58%. For medium-term interest rates, that drops to 40%. And then for long-term interest rates, the US only explains 20% of spillover shares. So, as I already mentioned, I don't just look at the spillovers to average developed and emerging interest rates. I also look at the spillovers to individual countries. So that's what this table shows. So here what I'm looking at is the impact of a spillover from, so what this number here means is it's the spillover from Canada to Australia, meaning if there's a 1 basis point rise in the 10-year interest rate in Canada around a Canadian monetary policy event, that's associated with a 0.33 basis point rise in Australia 10-year interest rates in the same high-frequency window. So broadly what we can see, and I highlighted the 8 countries that have the strongest spillovers, which means a p-value of less than 0.1%. So, and then just to be clear, so these are the sources of the spillovers, and these are the recipients of the spillovers. So you wouldn't expect that the Canada to Australia is going to be the same as Australia to Canada, because it's spillovers from one to the other, versus they're not going to be the same. So what we see broadly here is that each of the countries that has the most significant spillovers causes significant spillovers to at least 3 countries. So that means that these results are pretty broad. It's not just they're not just affecting one country. They're affecting many different countries. A second point that I would note here is to look specifically at this column, the USA column here. So what this shows is the spillovers from each of these countries to the USA. So what we see is that many central banks cause spillovers to the USA. So if there's a 1 basis point rise in Australian 10-year interest rates, that leads to a 0.1 basis point rise in the USA 10-year interest rate in the same high-frequency window. And then similarly, we find significant effects for Canada, Switzerland, Czechia, the European Central Bank, Great Britain, and Sweden. And also these effects are, again, very significant. They're significant with a p-value of less than 0.1%. So I would argue, and one other thing I would point out here is that there are some interesting pairs of countries here. So while these effects do have broadly significant effects, there do seem to be some notable spillovers where there are, which are interesting. So basically, we see that for Australia, its largest spillover is to New Zealand. And for New Zealand, similarly, its largest spillover is to Australia, although it's not actually significant. And then for Norway, its largest spillover is to Sweden. And then for Sweden, its largest spillover is to Norway. This one. So it seems like, in general, we're finding that there are certain countries that have kind of links where you get the strongest spillovers, which is maybe not that surprising. So one other thing that I'd like to show you, just to show my results make sense, is that basically the results are similar with different windows. So in panel A, I'm showing you the standard coefficients for the 10-year interest rates. In panel B, I'm varying the time frame. So rather than looking at 1 hour before to 1 hour after, I'm looking at 20 minutes before to 20 minutes after. And what I find is very similar results. And then for panel C, I look at 1 hour before to 1 week after. So so I'm basically looking at the same source country measure. So for the source country, I'm still looking at 1 hour before to 1 hour after. But for the recipient interest rates, I'm looking at 1 hour before to 1 week after to try and get a sense of whether these spillovers have long-term effects. And basically what I find actually is that obviously these numbers are not really significant that much, but that's not surprising because like I'm looking at a much wider panel, so there's going to be a lot more noise. But what we see is that for the coefficient numbers, every single one is actually larger than the number in the original panel A. So basically, if anything, these numbers are getting larger, showing that if anything, maybe it takes time to process the impact of these spillovers. And definitely what's not happening is that these are just like a blip, and then things go straight back to normal 1 hour after the monetary policy events. Yeah, so basically, so this one, so if you see here, what's happening is that for some countries, I don't get the individual results. So when I'm looking at, so for they're just not included in this table. So for example, like Australia, we can't measure the Australian impact to Norway just because there isn't enough interest rate data. So doesn't quite fit in terms of like market openings because like the definitive data is like based on like trade indicative quotes submitted by banks. So basically they can be available at slightly different hours to market openings, but still you're right that we don't always have this data available. And then when I'm looking at, but for these regressions, I'm looking at the average for any available data. So basically I look at a monetary policy event, and then if there's a response of like, I look at the response of like every available country that exists in my panel. So it might just be that I only have, for say Australia, I might only have say New Zealand and Japan. Or sorry, not Japan, I don't use Japan in the developed average, but just because it's a little bit unique. But I might only have say New Zealand. Maybe for Sweden, I might only have the European countries. So that's basically. Well, typically for USA, you would also have like ECB Great Britain because this bond data does, they do come out. They do come out outside. It's not just market openings basically. So you do get some data outside of that. So basically, it wouldn't just be Canada. It would be other countries as well. And that's what you can see here is that like for the USA, when the USA changes, you do get data for quite a few countries. So it's definitely not just, but you see the most points for like Canada, 369, whereas not all of the points are available in Australia just because that data isn't available. So basically in this table, so hopefully I've convinced you of the fact that like these are not like blips in the pan kind of temporary things. These do seem to have lasting effects. So I do a few other robustness checks just to make sure that my results make sense. So I show that I get similar results when I consider different year subsets. I get similar results when I compute the yield curves using alternative interest rate measures. And I get similar results when I control for the general co-movement interest rates outside of monetary policy events. I'm going to go through this relatively quickly. So here what I find is that basically there are significant spillovers to corporate interest rates in other countries. So basically here I show significant spillovers to USA AAA. I have to use a daily window for corporate interest rates because it's not available at an intraday measure. But I find significant spillover, I find positive numbers for all countries to the USA AAA bonds, both for a 1 day to 1 day after window and for a 1 day to 7 day after window. So that's panel A and panel D. And I also find significant spillovers to USA BBB and also to Asian corporate bonds as well. And then for other asset prices, I find that there are significant spillovers really only from the USA. Like these measures are measured using intraday data using the same 1 hour to 1 hour after window. But I find significant spillovers from the USA to other developed stocks, to emerging market stocks, to gold prices, and to silver. But I don't really find these results for other central banks. Maybe a little bit for the ECB to other developed countries' stocks, but not really that much. So I also look at determinants of spillovers. A couple of things I would stress here are that firstly, I find that non-Federal Reserve central banks seem to primarily spill over through, they seem to be larger when the pairs of countries have cultural ties, whereas for the USA, I find that the spillovers tend to be larger when there's both cultural and economic ties. The other thing I would point out here is I find that, that non-Federal Reserve central banks spillovers are primarily driven by changes in the term premium of the source country. And this is different to the Federal Reserve, where I find that basically the expected path of interest rates has a much more important role to play in determining the size of spillovers. So now let me summarize what I find overall about the differences between spillovers from non-Fed central banks and from the Federal Reserve spillovers. So for the Federal Reserve, I find that, and for other central banks, I find they both spill over to developed countries. However, I find only the Federal Reserve spills over to emerging markets. I find that both the Federal Reserve and other central banks spill over to corporate bonds. However, only really the Federal Reserve spills over to stock markets and to other gold and silver prices. I find that the Federal Reserve spills over to short-term interest rates while other central banks do not, but other central banks do spill over to medium and long-term interest rates. And then I also find that, that the term premium is really the only part of the only real part of the source country that's driving the change in spillovers, whereas both the expected path and the term premium play a role in the Federal Reserve. And finally, we have that cultural links are really the driver of the results in other central banks. So therefore, as a result of this, I argue that spillovers from non-Federal Reserve central banks seem to be driven by a bond pricing channel. So the idea of this is if a central bank lowers interest rates, similar bonds in other countries become more attractive. So so what happens is basically the price of similar bonds in other countries will rise as a result of the fall in the interest rate in other countries, in the source country, and therefore their yield also goes down. So the implication of this is that basically investors are going to want to invest in similar bonds to what they were previously invested in. So basically I argue that they're going to want to invest in similar countries. So basically if I have a spillover from a developed country, it's going to primarily affect other developed countries. I don't find this with emerging countries, I think, because they're just so different. Emerging countries have just so much more interest rates in emerging countries are driven so much more by the possibility of default, so they're not really as relevant and not as similar in terms of their assets. I also find that cultural links seem to play a key role, which makes sense because investors are going to want to invest in similar countries. Additionally, I find that these spillovers are going to occur to medium-term and long-term interest rates, and this kind of makes sense because basically bond prices in other countries are going to be pinned down by the expected path of interest rates in those other countries. So there's not going to be the term premium through which this channel is occurring is not really going to play that big a role. And so there's just not going to be that much movement in other countries' interest rates as a result of this bond pricing channel. However, it will have the term premium does play a much larger role for medium-term and especially for long-term interest rates. And that's why I find that that there's much larger spillovers to medium-term and long-term interest rates for these other non-Federal Reserve central banks. Additionally, I find that there's an impact on corporate rates. I think this makes sense because, in general, corporate rates are particularly driven by interest rates in sovereign countries, on sovereign bonds. And so basically, you would expect there would be a close link between corporate bond interest rates and sovereign bond interest rates. However, I don't find any particular spillovers to other asset markets. I think the reason for this is simply that people don't really know. I mean, you would expect an impact if people understood that there were going to be changes in interest rates in other countries as a result of changes in the source country. But I think people just aren't really aware of this channel, and so you don't really see any particular impact of these spillovers to other assets. So to conclude, I find that 14 non-Federal Reserve central banks cause spillovers. And these are particularly important for medium and long-term interest rates for sovereign and corporate bonds in similar countries. However, I do not find that these spill over as widely as for the Federal Reserve, and the Federal Reserve additionally spills over to other assets, short-term interest rates in emerging markets. In particular, I find that these spillovers seem to come through a bond pricing channel, and I think, unlike the Federal Reserve, which spills over through far wider channels. And I think this can explain why there are narrower effects than for the Federal Reserve. And then finally, I would argue that the fact that there are much larger spillovers, at least to certain assets, shows that central banks are going to face far greater headwinds to their monetary policy in certain areas than are typically accounted for by the literature. And this is particularly true for the Federal Reserve, which is just not typically seen to be affected by spillovers. Thank you very much.
Thank you very much, Thomas, for inviting me to discuss this paper. It was a very interesting read. So let me just give you a quick summary of what the paper does. So this paper measures the spillovers of monetary policy events from various countries, from 20 countries to their peers. And it looks at bilateral spillovers, but also spillovers to the average of the other countries. So what it does is it uses a high-frequency identification scheme, and most of you are probably familiar with this technique. But in the end, what you need for that is certain monetary policy events. So the paper uses meetings, release of minutes, but no speeches, but also the exact timestamp when these meetings happen or the minutes are released. And then what you do is you use high-frequency financial market data to compare the change of financial market data just before and after this event. And what the identifying assumption essentially is that this change in the financial market variable can be attributed solely to the monetary policy event. And this identification gets much more credible if you make this window narrower, because then you can claim that most of the variation in the financial market variable will be solely due to this monetary policy event. Its main focus is essentially on the spillover of changes in government bond yields, and it claims to establish a causal relationship from the changes in the domestic bonds caused by the monetary policy event to foreign bonds. Now, the main findings are as follows. Central banks other than the Fed, and that's probably the most surprising one, cause significant, even though somewhat less important spillovers to other bond markets. And these spillovers, or the degree of spillover, is related to the size of the economy, also cultural proximity, but not necessarily geographical proximity. And I think this is kind of the, as I said before, it's kind of the most surprising, or the most, the new finding of the study is that even the US is subject to spillovers from other countries. So essentially from relatively small countries, there are spillovers to US bond markets. So let me give you a kind of a general assessment of the paper. I think it's a great paper. It reads very well. It was very interesting. And especially it's about an important topic, because we need to know more about the international propagation of shocks. The paper focuses on monetary policy and its effect through bond markets. But of course, as the recent experience shows, of course, international linkages play an important role in the propagation of inflation, financial crisis, and so on. Now, the existing literature focuses mostly on large central banks, as Chris pointed out, partly because probably the data is just available more easily to obtain, but then also because the prior is that these large central banks have more significant spillovers to other countries. Now, I think this is a strong point of the paper, that it includes smaller central banks, because also smaller central banks are active in international financial markets. Think about the Swiss National Bank, for example, which heavily intervened in the foreign exchange market and bought massive amounts of foreign assets. Now, it also includes emerging economies. That's also a strong point, and in my view, overall, it's an impressive data set, an impressive data collection. Now, in what follows, I will give basically 3 comments on how I think the paper could be improved. I don't think the main results will change much if you follow these recommendations, but still it provides some food for thought. So what one worry could be is that in these high-frequency identification schemes, you kind of face a trade-off. How large do you want to make this time window? So on the one hand, as I said before, you want to make this time window as narrow as possible to really credibly claim that there are no confounding factors that influence the change in the domestic interest rate. On the other hand, you also showed that there may be dynamic effects, that the effects may increase over time because maybe it takes time for financial markets to process all the information that the central bank released. So that would mean that you would need to choose a larger window in the domestic economy to actually capture the entire change. But then you introduce more confounding factors that happen at the same time. So some people have used an instrumental variables approach to address this issue to some extent that allows for some noise in your high-frequency identified proxy for the change in the interest rate around the monetary policy event. So that might be a way to go. Possibly you could also add lagged control variables to just reduce the noise in the data somewhat so that some results might get more significant, but this depends a little bit on the nature of your financial market data. And then kind of one open question that I had is, what is the reasoning to match the maturity of the change in the domestic interest rate and the foreign interest rate? I didn't find kind of an economic reasoning why you want to do that, because many papers that I saw, they kind of say, well, let's look at the change in the short-term interest rate, and then how do other interest rate change? The reason being that kind of the prior is, well, if the central bank changes the target for the short-term interest rate, that is kind of the variation that you would like to capture, and long-term interest rate might be affected by other things other than just the change in the policy rate. Now, of course, this depends a little bit on what you want to capture. If you want to capture also things like forward guidance, and then, of course, maybe the long-term interest rate would be the way to go. But still, I missed the discussion of this point. Then let me talk briefly about the interpretation of the results. So, as I said before, the paper states that it is a causal effect from a change in monetary policy that affects, say, the 10-year interest rate in Switzerland, and then this has a spillover on the 10-year interest rate, say, in the United States. Now, let me just outline kind of an alternative story. I think this affects most papers that look at interest rate spillover, so this is not something that is specifically problematic in this paper, but I just think this is an interesting question to think about. Now, central banks release a lot of information on these days with monetary policy events, but it may well be, but they release that information in a lumpy fashion. So they have their monetary policy meetings, maybe they have some scheduled speeches, they have fixed dates where they release the minutes. So it may well be that the situation in the world economy changed during the meeting of the Fed and the next meeting of the Swiss National Bank. But then the Swiss National Bank provides information about the economic situation in the US that the Fed did not yet release, because the Swiss National Bank also monitors the US economy. So this means that bond prices in the United States would change because of this change of the information set released by the Swiss National Bank. But then, because the Swiss National Bank is, Switzerland is a small open economy, this spills back to the bond prices in Switzerland. So my question would be, well, if this story is partly true, do we interpret that as a causal effect from Swiss interest rates to US interest rates? I would rather say, well, this is then kind of information from the Swiss National Bank that affects US interest rates, that then in turn affects Swiss interest rates. So again, I don't think this is particularly this is kind of just a problem for your paper, but in my view, this is kind of an interesting question to think about what kind of information is really released on these days with monetary policy events. Then you also look at the degree of spillovers with, or what dimension correlate with the degree of spillovers, and I think this is very interesting, but here are just a couple of other dimensions that you could look at. So I asked myself, well, how large and liquid are these corporate and sovereign bond markets, and does this maybe affect the degree of spillovers? Then also some of the countries that in your sample may issue US dollar denominated debt, and this may be to some extent important because this would also be related to the exchange rate regime. So you could think about, well, a country with a very flexible exchange rate might have a smaller spillover to other countries than a country with a fixed exchange rate possibly. So does the exchange rate regime play a role? Similarly, capital controls, so you could imagine that for countries with capital controls, the spillovers might be smaller than for countries without capital controls. And then finally, in your sample, you have a relatively long period at the effective lower bound of short-term interest rates. I think that could be one reason why you want to look at long-term interest rates, really, because these are not affected to the same extent by the effective lower bound, but still this might affect some of your results for short-term interest rates as well, and that would be just another dimension that you could investigate whether this plays a role for your results. I'm not sure how I do on time. Okay, then I will just, these are really just smaller comments, so I'm happy to share the slides with you, so maybe that you could take into account. So I just kind of asked myself, well, what is the role of the exchange rate really? And then you could think about estimating the effect on bilateral exchange rates. I think the monetary policy events for the SNB are available before 2004 from their website, but I think there is no timestamp. But my guess is once you have the monetary policy events, you could probably look at the high frequency data to see where the most important changes are and maybe still fill this data before 2004. Then I was not completely sure what indicative quotes submitted by banks mean. You also mentioned that before. Then I asked myself, is this actually based on actual trades? How liquid are those markets when you get these indicative quotes by banks? How reliable are those data compared to data where you observe actual trades? So that was kind of a question that came to my mind. Then you talk a little bit how you disentangle the effects with respect to the term premium. That was, for me, when I read the paper, it was not totally clear how you did that. So maybe a bit more elaboration in the paper would be useful for the reader. I already mentioned the focus on long-term interest rates was not immediately obvious. I think you can justify it, for example, with the effective lower bound, but I think it could be stated more clearly. And then also, I think you didn't talk about that, but the question arises, well, what if on the same day there is a monetary policy event by another central bank? How do you disentangle the two? And you do some tests whether this is important, but I thought, well, why not just include these events as a control variable in your regression, and then you could immediately claim that, well, this is orthogonal to these monetary policy events. So with that, let me end the discussion here. Again, I think it's a great paper, and hope these points will be useful for you.
Okay, thank you very much for coming to the session. The paper is a joint work with Marek, who's on leave from the ECB, visiting, I think, the New York Fed by now. It's very much work in progress, so I'm very happy to be here because I think this is the right audience to present this paper to. It's about the global implications of US monetary policy. And I think the motivation is very straightforward. We all know that US monetary policy has entered the tightening cycle. We know that there are record inflation rates, and I think yesterday the panel also made clear that we expect some serious tightening going forward. And there's a lot of literature on US monetary policy spillovers. We saw something already today, and we're going to see more later, at least involving the role of US monetary policy. But what's particularly pertinent at this juncture is that the tightening will involve several dimensions of the Fed toolkit. There is the federal funds rate hike, there is forward guidance, there is the unwinding of purchased assets, and there's also this additional dimension, which I think was already discussed in the discussion, namely this dimension of perceptions versus communication, namely whether a tightening is perceived as reflecting the policy rule of the Fed, namely tightening against the background of the expansion of the US economy, or whether it's conveying that the Fed has a different view about where the US economy is going. So in this paper, the questions that we address are all revolving around the implications of Fed monetary policy tightening for the rest of the world. We look specifically at a couple of sub-questions. The first one is we look at the implications across the toolkit of the Federal Reserve. Policy rate hikes, forward guidance, and LSAPs. Then we also try to shed some light on the transmission chance across these dimensions. We try to look specifically at the implications for the current juncture, namely where we expect further tightenings against the background of an expanding US economy, so some form of nonlinearity. And then we also look at the role of macro-financial vulnerabilities in receiving countries and the stage of the business cycle in receiving countries for shaping the spillovers that they receive. So at this stage, I should say this is an exploratory paper, it's a descriptive paper, so we try to establish some stylized facts, how these different dimensions of the Fed toolkit transmit to the global economy. Okay, so what do we find? First of all, we find that spillovers are large. That's really not anything new. There's a long literature which has documented this already, but let me say again that what we add here is resolution. Resolution in terms of the different dimensions of the Fed toolkit. So especially we find that spillovers from forward guidance and LSAP are large. Those from conventional monetary policy are rather small, if they're meaningful at all. So if you think about the Fed monetary policy statement, having a section on the federal funds rate target, having a section of forward guidance and LSAP, what our results suggest is that if you're a small open economy policymaker, what you should focus on is the communication about forward guidance and LSAP. The federal funds rate itself is not very, doesn't have much predictive power for the spillovers that you're going to receive. What we also find is that these two dimensions of the Fed's toolkit, forward guidance and LSAP, they also entail trade-offs in emerging markets. They lead to output prices moving in different directions, and also leading output and prices on the one hand and capital inflows on the other hand to move in directions that make it difficult for local monetary policies to stabilize all these different targets, if you will. In terms of transmission, yet again, our papers suggest that financial channels are key. For emerging market economy, the results suggest that risk on and off effects are important in transmitting the Fed stance to the rest of the world, whereas for advanced economies, it seems more to be based on the role of currency mismatches and their implications for the lending behaviors of global banks. In terms of non-linearities, first of all, we find that Fed monetary policy tightening against the background of an expanding US economy is generally benign for the rest of the world. And there's some theoretical work out there that looks at this question of non-linearities in the context of the domestic effects of monetary policies. And one rationale put forth here is that when the economy is expanding, then households and firms are far away from their borrowing constraints, so a negative shock is less likely to make these agents hit their borrowing constraints, and thereby the financial accelerator effects are very limited, and thereby the effects of tightening are benign in the context of a business cycle expansion. Now we look at this in the context of spillovers, so apparently this may also apply to the rest of the world. The mechanism may also apply to the rest of the world. However, at the same time, we also document that even though this previous result on the benign nature of the spillovers from Fed monetary policy against the background of US business cycle expansion is true for the average economy, it's not true for all economies. Macro-financial vulnerabilities, especially in terms of dollar exposures, misaligned exchange rates, and weakly anchored inflation expectations, they are associated with countries receiving much higher, larger spillovers from Fed monetary policy. And we also find that being in a recession also is associated with receiving larger spillovers from Fed monetary policy. So I want to talk a little bit about the identification of monetary policy shocks, because we use a novel approach that's not established yet in the literature. It's based on a previous paper by my co-author Marek, and so I'm going to spend a couple of slides on this just to advertise it and to explain how this works. And then I'm going to talk about, I'm going to show you our main results, and there's much more in the paper. Maybe that's the reason why Ambrogio also was reluctant to discuss it, because it's a very long paper at this stage. But I think that's already a good flavor of what we have in the paper. So Marek, he proposes identification through independent component analysis, and he starts from the industry standard, actually what we saw in the previous paper, namely high-frequency surprises in asset prices around FOMC meetings. But then he observes that these asset price surprises, especially the interest rate surprises, are very non-Gaussian, very leptokurtic. And what he means by that is that if you plot a histogram of these surprises, then you will find that most of the times, for most FOMC meetings, these surprises are very, very small, are very close to zero. But there are some meetings where there are pretty large surprises, okay? So these are not normally distributed. They are very leptokurtic. And then he postulates that, okay, there are some unobserved structural shocks in the data. Okay? These are thick-tailed, they're leptokurtic, they are fat tails, and that's actually sufficient in order to back out these structural shocks from the data. Okay? So the thick-tailedness is sufficient to back out these structural shocks from the data. It's important to emphasize that there's no recursiveness assumptions, no sign restrictions, no magnitude restrictions needed in order to back these shocks out from the data. Okay? But so far, I've just talked about structural shocks, right? So what then happens is this labeling of the shocks, and that happens very much as in this identification through heteroscedasticity approach, pioneered by Enrico Bon, early 2000s, where the labels are attached to the shocks ex post based on the impulse responses that these shocks elicit. And what Marek does in his paper, and I'm going to show you this on the next slide based on an exercise from our paper, is to look at the impact day financial market effects of the shocks that he backs out from the data, and based on the patterns in the financial market effects, he labels these shocks. So before I show you this exercise, I want to mention that I think this approach is, I should say, almost unique, because it does two things simultaneously. And the first thing is to capture separately shocks to the different dimensions of the Fed's toolkit, namely conventional monetary policy, forward guidance, and asset purchases, and also distinguishes between these pure monetary policy shocks, these traditional monetary policy shocks, and the Fed information effect, which was mentioned in the previous, in the discussion of the previous paper. So let me show you this labeling, because I think it's quite striking how well this works. So what you see here on this slide are the impact day financial market effects of the 4 shocks that Marek backs out from the data. And you see these effects for treasury rates with different maturities, the expectations components, so the risk-free components of the treasury yield curve, term premia with different maturities, and equity prices. And whenever these bars are filled, it means that, that the effect is estimated to be statistically significant. So let's look at the first shock. The first shock, it raises the yield curve, lifts the yield curve. It does so primarily at shorter maturities. It raises the yield curve exclusively through the expectations component, through the risk-free component. And it leads to contraction in equity prices. And so this looks pretty much what a conventional monetary policy shock would do. And so he calls this the conventional monetary policy shock. Second shock also lifts the yield curve, but much more so at medium-term maturities. Again, almost exclusively through the risk-free component. Also leads to contraction in equity prices, and so this looks pretty much like a forward guidance shock. Third shock also lifts the yield curve only at longer maturities, does so exclusively through term premia, and so this is what we expect an LSAP shock to do. Fourth shock, again, lifts the yield curve only through the expectations component, which looks similar to the second shock, but in this case, we have an expansion in equity prices, and so this is pretty much the Fed information effect. This is pretty much what we would expect a Fed information effect to produce. And so he calls this the Delphic forward guidance shock, in line with Campbell and others in an early paper. So he has the Delphic forward guidance shock and the Odyssean forward guidance shock. Delphic forward guidance shock is the central bank information effect. Odyssean forward guidance shock is the pure monetary policy shock. And in the following, we're going to look at the effects of these shocks, not on financial markets on the day, but on medium-term horizons. So we start with, yes?
Are they, some of the techniques you basically rotate the effect of the shocks to get different results also, and this one's not that, makes a kind of constructs a rotation of the shocks that then looks like, say, a subshock. Is this similar here, or these are the shocks that you just get?
Yeah, so when, the likelihood is the same for different rotations of the shocks when the shocks are normally distributed, but not anymore when they're thick-tailed. And so the rotation is pinned down by the likelihood already. So there's only a unique rotation that gives you these shocks, which maximizes the likelihood. Okay, so we start here from the spillovers to real activity in the rest of the world. This is what you see here depicted with the black solid lines. And what you see with the red cross lines is the domestic effect in the US, the effect on US industrial production. And there are 3 observations. The first one, if you look at conventional monetary policy, spillovers are very small. They're not meaningfully different from 0, actually. Second observation, for Odyssean forward guidance and for LSAP shocks, the spillovers are pretty large in the sense of being of the same order of magnitude as the domestic effects in the US. And the third observation, Delphic forward guidance shock, this Fed information effect, is expansionary for the rest of the world. Okay, so I think this is notable. It's not the first time to be documented. It's still notable. When there is a Fed tightening, the rest of the world expands. And so this, again, is consistent with this tightening, just reflecting that the Fed is holding a more bullish view about where the US economy is going, either in terms of real activity or prices. And that, of course, in a globally integrated world also has implications for where the global economy is going. So here we look at financial channels. First row shows you the results for this, the effect on risk aversion. Second row for rest of the world equity prices. And you see that the pure monetary policy shocks are contractionary for equity prices, global equity prices, and they raise risk aversion. Whereas the Delphic forward guidance shock, the Fed information effect, it reduces risk aversion, and it's expansionary for rest of the world equity prices. And I think that already points to the importance of risk on, off in the transmission of Fed monetary policy to the rest of the world. This also applies to capital flows. What I show you here are results for US portfolio outflows, defined as net increases in US investors' holdings of foreign portfolio debt and equity. And what you see again for the pure monetary policy shocks is that there is a drop in outflows, US outflows to advanced economies and emerging market economies. So there's some repatriation. Same for LSAP shocks, but for Delphic forward guidance shock, which I already mentioned, could be interpreted as, seems to reflect the risk-on effect. There is an increase in outflows, US outflows to advanced and especially emerging market economies. Okay, so a little bit more circumstantial evidence for the role of risk-on in transmitting Fed monetary policy to the rest of the world. We do more in the paper in terms of distinctions between instruments and country groups. That would be too much for today. Here's one more distinction between advanced and emerging market economies. You see in the first row the response of the dollar effective exchange rate, separately for advanced and for emerging market economies. Advanced economies is in red and emerging market economies is in blue. What you see is that for a distant forward guidance shock, this pure monetary policy shock, the response is not really different across advanced and emerging market economies, but there's a very pronounced difference in the response of the dollar exchange rate vis-a-vis advanced and emerging market economies. And that's, I think, pretty much consistent with what especially BIS work has come up with, namely this triangular relationship between risk, the dollar exchange rate, and in the second row you see cross-border bank credit, and that's the third leg of this triangular relationship. When the dollar depreciates against emerging market economies because of a risk-on effect, then this is not contractionary for cross-border bank credit to emerging market economies. But as the dollar appreciates against advanced economies, that is contractionary for cross-border bank credit to advanced economies because of the currency mismatches. But that's an interpretation. That's consistent with this argument here, but that's an interpretation. That's consistent with the role of currency mismatches on the balance sheets of either global lenders or global borrowers. Okay, next thing is trade-offs. That's, I think, an important aspect because spillovers per se are not necessarily bad from a welfare perspective. They're particularly bad if they cannot be neutralized for variables that local monetary policy cares about. And so we look here at trade-offs between output and prices on the one hand, and then what we call macro stability involving output and price stabilization, and financial stability on the other hand. Here you see our results for trade-offs in emerging market economies for output and prices. First row shows you results for the spillovers to emerging market industrial production, and second row for consumer prices. And you see that for forward guidance, both Odyssean forward guidance and Delphic forward guidance, output and prices move in opposite directions, which implies a trade-off for local monetary policy. Imagine local monetary policy wanted to dampen the output spillover, so it will loosen, but that would put further upward pressure on consumer prices through exchange rate pass-through and the expansionary effect on real activity. On the other hand, there's no trade-off for LSAP shocks, at least no trade-off between output and price stabilization. At the same time, LSAP shocks also elicit trade-offs between, macroeconomic stabilization on the one hand and financial stabilization, financial stability on the other hand. This is what you see here. First row shows you just what you saw on the previous slide, namely spillovers to industrial production, that's a red impulse response, And consumer prices, that's the blue impulse response. And you see that for L-sub shocks, they move in the same direction, so no trade-off between stabilizing output and prices for L-sub shocks. But they lead to, L-sub shocks lead to contraction in capital inflows in emerging market economies. And so again, if local monetary policy wanted to stabilize these inflows, it would tighten, but the tightening would be contractionary for output and prices. So again, there's a trade-off. Okay, then the final part of the paper is on nonlinearities. And as I mentioned before, we look at two dimensions of nonlinearities, the role of macro-financial vulnerabilities and the stage of the business cycle, both the US business cycle, but also the local business cycle. Results here are for the stage of the US business cycle. You see here two impulse responses. The blue impulse response reflects the effect of contractionary Fed shocks in US business cycle expansions, and the red in US business cycle recessions. I should emphasize here that we do not only normalize these impulse responses to reflect the effect of contractionary shocks, we also only use contractionary shocks in the estimation. Okay? And what you see here, if you take this at face value, is that contractionary shocks in business cycle expansions, US business cycle expansions, are actually even slightly expansionary in the rest of the world. I think because we slice up the data here in terms of two types of nonlinearities, we should be a bit more pragmatic and interpret this as suggesting that the spillovers are benign. They're not contractionary. Okay? Okay, so this, again, taken at face value, would suggest that the global implications of the tightening, of the normalization of monetary policy in the US that we observe now should be benign, okay? Which is a bit of a surprising result. And so we look at more vulnerability, more nonlinearities here, to nuance that finding. In the first row, you see the effect of US monetary policy shocks for rest of the world country-level industrial production, separately for more vulnerable economies and less vulnerable economies. Vulnerability here is an index that we construct based on information on countries' dollar exposures on the external balance sheet, their dollar liabilities, misaligned exchange rates, and weakly anchored inflation expectations. And for all those three dimensions, you have literature that suggests that these are country fundamentals that shape spillovers. And what you see is that especially for forward guidance shocks, both Oesterreichische and Delphic forward guidance shocks, real activity in the rest of the world is more volatile, conditional on US monetary policy shock. Okay? And the same you see for the position in the local business cycle. Economies that are in recession experience greater volatility in real activity conditional on forward guidance shocks, both Delphic forward guidance shocks and Oesterreichische forward guidance shocks. And so in terms of policy implications, that of course points to the importance of keep your house in order. Right? So you limit macro-financial vulnerabilities, keep in check dollar exposures, macroprudential policies, potentially capital controls. You try to avoid misaligned exchange rates and try to stabilize the domestic business cycle. Okay, so let me wrap up. We look in this paper at the implications of Fed monetary policy tightening. What's, I think, special about this paper is that we look at the different dimensions of the Fed toolkit, both in terms of pure monetary policy shock and central bank information effects. We find that especially forward guidance and L-sub shocks elicit large spillovers to the rest of the world. Conventional monetary policy shocks don't seem to be that important. Yet another paper that suggests financial channels are key, especially risk on-off effects for emerging market economies and more currency mismatches for advanced economies. All dimensions of Fed monetary policy elicit trade-offs in emerging market economies. So that, I think, feeds into the discussion about international monetary policy coordination, rules of the monetary game, and the monetary tsunami. At the current juncture, overall, because the US business cycle is expanding and with it also some other parts of the world, overall, these spillovers should be benign. At the same time, that's not true for all economies, especially economies exhibiting macro-financial vulnerabilities and economies in recession are probably going to experience greater volatility. So I'll stop here, and unfortunately, there's no discussant.
Thank you for attending this session, and I will conclude this session with a presentation about the monetary policy effectiveness in light of diverging national policy stances. And if you think back to the situation we had in December or in at the end of 2021 when the US started its tightening cycle and scaling down the asset purchases, we in the euro area were still very expansive. And so the question is there any hampering effect on monetary policy effectiveness in the euro area? This is joint work with my colleagues from the University of Salzburg, Nico Hausenberger and Florian Huber, and the usual disclaimer applies. For motivational purposes, I want to show you this picture here. It's a very simple picture where I plotted on the y-axis the real 10-year euro area government bond yield, and on the x-axis monetary policy surprise measure. What this is, I will elaborate a little bit later. For the moment, just accept that this is kind of an exogenous monetary policy surprise measure. You see two colors here. I split the sample where during surprises in the euro area, the United States Federal Reserve were also expansive or restrictive in their surprises, which yields a lower and an upper quantile here. And you see the blue line here is upward sloping. That corresponds to a restrictive US policy surprise. And we observed the effect that we would expect, namely an increasing of real bond yields when we have a positive surprise. When we now go to the opposite situation where we have an expansive US policy surprise, we observe a downward sloping line here. So that means somehow an increase in or a positive monetary policy surprise would result into a decrease of the yield, bond yield. So this is somehow puzzling here. Needless to say, not a very suitable model for analyzing this here. Afterwards we thought about, okay, what could be the case, what could be the reason for getting this picture? One is that there exists some kind of policy spillovers that crucially impede the monetary policy transmission in the euro area. So that's why I show you here the three channels that might be causing this effect. And just briefly wrapping up the three channels we are aware in the literature: the aggregate demand channel that mainly operates through trade and general macro conditions. Obviously, this depends on the degree of openness. In the last years, we observed actually an increasing importance of trade. So, yeah. The second one is a more exchange rate related that concerns basically the influence of the exchange rate on the relative prices between home and foreign goods, with also effects on the yield curve via the interest differentials and currency risk premia. And the last one, and this is something we focus in this paper, is the financial channel. So basically, we have the dominance of US dollar. We have the role of safe haven and the relative valuation of assets. And obviously, this is somehow linked to the yield curve and also market-based expectations in terms of inflation. So when we read the literature about the financial channels of the spillovers, we basically saw that something is missing, and we want to try this gap, to fill this gap here, to answer the following research question. So the broad question we are after is, how does the ECB's monetary policy effectiveness change with a changing federal monetary policy stance? And being more precise here, we want to have a look at the euro area yield curve and inflation expectations, reactions after a restrictive monetary policy shock in the euro area, conditional on the stance or the surprises of the Federal Reserve. And this is an empirical paper where we basically employ a nonlinear model to analyze these questions. And the model is a smooth transition VER model. I will talk on that a bit later. And because a lot of things and dynamics are going on in financial markets in a very high frequency period, we are looking on weekly data that pictures the whole euro area yield curve and the term structure of inflation expectations. So this is something we haven't seen before, and we want to check what happens within a week on financial markets after a monetary policy shock, conditional on the Federal Reserve stance. To circumvent the issue of identification of euro area monetary policy shocks, we use a very inconvenient measure of MP shocks provided by Carlo Altavilla and co-authors. This is also based on a high-frequency identification, a little bit less sophisticated than what Jorgo and Marek are using. And we also use instruments compiled by Wu, Rogers, and Wu about the Federal Reserve surprises that determine the state transition in our smooth transition VR model. The econometric framework is rather simple. In that case that we have basically two VR models, depicted here in the first bracket, and we link these two linear VR models with the transition function ST, and the state transition is determined by the signal we receive from the United States in terms of monetary policy surprise. You see that allows us to discriminate between a restrictive and an expansive regime here. And in the end, we have a mixture of the two regimes. Because of our logistic state transition function, we are also able to determine a probability to being in either of the regimes. What we have here as an input is the signal variable is the monetary policy instrument of the United States. We have a threshold value that we estimate. This is the mu here, which is centered on 0. And in addition, we have the parameter rho that governs the speed of adjustment between the regimes. Just to get a more intuitive view here, if this rho is very large, we basically collapse into a threshold VR, so a deterministic threshold. Yeah, so this is the model we are using. The data, we use weekly euro area instantaneous forward rates for 15 fixed maturities and the corresponding inflation swaps spanning the weekly sample from 2005 until 2019. Due to the pandemic, we omit the 2020 onwards. We use a lag length of 4. The problem is, even though we opt for a Bayesian approach on estimation, we have a highly parameterized model. To reduce this dimensionality, actually we use a parsimonious term structure model in the spirit of Nelson and Siegel and Diebold and Lee to extract factors that actually allows us to decompose the yield curve into a level, a slope, and a curvature factor. This is very convenient because instead of 30 variables, we end up with 6 variables because those 3 factors actually picturing us the whole yield curve and the whole term structure of inflation expectations. It's in another way very convenient because these factors have a sensible economic meaning because they denote the long end of the yield curve, so the level factor, the slope is the short end, and the curvature, the medium segment of the yield curve. Additionally, we include 3 macro financial variables, the Eurostoxx 50 for stock markets, the composite indicator of systemic stress to measure systemic stress, and the nominal exchange rate, such that we have this set of variables. As I told you, we circumvent the issue of identifying monetary policy surprises. We use this high-frequency based instrument compiled by Carlo Altavilla and co-authors. And in their paper, they used the high-frequency approach to check what happens within a narrow window around policy announcements. And they're able to extract 4 factors, the different effects on different segments on the yield curve. As we are after a full set of monetary policy, we use a linear combination of all of the 4 factors. For the United States, we rely on this Wu, Rogers, and Wu series here that is similarly compiled, also around FOMC, so the policy meetings in the United States. And we use here a moving average of degree 13, so a 1/4 moving average. That, at least in our interpretation, allows us to interpret this as a US monetary policy stance. We will see afterwards the discussion by Jorgo about that. Here, of course, we also have to check that we are not mixing it up with the central bank information effect. So we used a very convenient approach from Marek Jarocinski and using sign restrictions to really ensure that we obtain the monetary policy effect and distinguishing it from the central bank information shock. So we are here really having the pure monetary policy approach, policy instrument. For the estimation, I'll be rather quick. So I told you we opt for a Bayesian approach. We still have a very large system, so we are actually employing a shrinkage prior setup in the fashion of Cavallo and co-authors. So this is a horseshoe prior setup that allows us to shrink coefficients that are not supported by the data towards 0. So in addition, reducing so basically enhancing the precision of our estimates. The other priors are rather standard, and in order to not put too much prior information a priori, we opt for weakly informative priors for the threshold parameter. The support is here bounded between the minimum and the maximum of the transition variable. And our setup for the speed of adjustment allows a sensible regime allocation here. Well, unfortunately, the full posterior is of non-standard form, so we have to rely on MCMC algorithms, which I will not elaborate on here. The first intermediate result are the factors we extracted that depict actually the full yield curve and the full inflation swap curve. Here, unfortunately, time is scarce, so I will not discuss that too much in detail. I just want to show you that we have downward sloping trends for the yield curve factors. So that means the long-term interest rates in the euro area were decreasing since 2005, and also the inflation which we experienced in the past years up to now actually was also falling. We see some sort of yield curve inversion before the crisis, and then a flattening of the yield curves denoted here by the slope factor. And yeah, that's what we actually use as an input for our estimation. Now, I just want to show you the monetary policy surprises for the United States and the euro area. I won't discuss this in detail. I just want to highlight that the correlation between those two instruments is not very high, except for periods of pre-crisis and during crisis. So there is actually the coordination between the Atlantic is not so pronounced, I would say, except of reactions to global shocks. Then what we can do with the model is basically infer the state allocation. On the left-hand side, you have the probability to be either in an expansive or in a restrictive regime. The gray bars indicate this. And on the right-hand side, the scale depicts the US monetary policy surprises smoothed with the quarter moving average. And we see that, during times of crisis, we are clearly in an expansionary regime, which totally makes sense. And then we see some episodes of also very expansive, of a very expansive regime. So that's basically the state allocation. But the most important and the most interesting thing comes now. Namely, what we are doing is a thought experiment. We are now shocking the euro area with a restrictive monetary policy shock and condition on a rather loose or a rather tight Federal Reserve monetary policy surprise. So basically, we carry out scenario-specific impulse-response functions because we can do that with our model setup. What I show you is a bunch of impulse-response functions for the 5 and 95 percentile. So basically, we use the extreme values, but in a second slide, I will show you the directions over a continuum to show that also if we are not in such extreme areas, we observe a nonlinearity, a strong nonlinearity. Okay, so blue, the color blue means we are in a divergence scenario, so we are having a experience a restrictive monetary policy shock in the euro area, but an expansive shock in the United States. Red is the line scenario where we basically have in both economic areas a restrictive shock. So what we observe is on impact, we have an increase in the various yields here, slightly less pronounced on the long end of the curve. After 1 week, we observe a very interesting phenomenon, namely that we have an additional increase in the divergence scenario for all yields under scrutiny. But then, instead of going back towards the mean, we observe an undershooting, so a decline of the the short end yields. Down to negative territory until the mean reversion sets in. So obviously the misaligned monetary policy produces a strong interest rate differential, which is also depends on the maturity we are looking at. So as I promised, I will show you the continuum. That means we have a contractionary Fed, which is located at unity here, and the very expansionary Fed at 0. I showed you the 5 and 95 percentile before. Now you have the continuum. And what we actually see is the results support that we have a nonlinearity here, and that's quite substantial until, I think the mean of the distribution of the monetary policy instruments of the United States. So we surmise somehow that this is somehow caused by portfolio reallocations due to the US dominance. But the more interesting results, at least for me, are the selected inflation swaps. Because here we observe that on impact, we have a very straightforward or very intuitive reaction, namely that we have, after restrictive monetary policy shock in the euro area, a decline in inflation swaps all over the maturities. But then if we have a divergence scenario, meaning that we have simultaneously an expansive Federal Reserve, we have an upshooting of the expected inflation, the inflation swaps all over the maturities, and quite substantial, I would say. So the aligned monetary policy stances attenuate inflation expectations quite clearly over the whole curve. But when we are in a divergent stance, we have an increase of inflation expectations all over the place. And we argue that this is somehow the important inflation expectations play a role. Again, the same picture as before, just now for the continuum of scenarios for the inflation swaps. Again, a very strong sign of nonlinearity. And we see that we are in the positive territory almost always across the maturities here. And we conclude basically that the effectiveness of monetary policy, at least in managing inflation expectations, is crucially impeded. We have a very different monetary policy stance across the Atlantic. So this is, I would say, a very important aspect for policymakers to think about what could happen from spillovers from the United States. Then the last slide before I conclude, we also have the exchange rate, the stock markets, and the CISS here. We observe in all cases euro appreciation, which is according to our economic intuition. However, this effect is stronger if we have a divergent Federal Reserve here. For the stocks on impact, due to our identification, we have a negative effect, which stays negative if we have a restrictive contemporaneous Fed. However, it turns positive in a divergent scenario, again, giving this scenario specific impulse response functions after 1 week here for the stock markets. The CISS is not really different in the stances, but either way we wanted to check if there is something going on with systemic stress. Obviously, we have to do some robustness checks, especially regarding the monetary policy instrument and the transition variable. And the problem we are facing here is that we are on a weekly basis. That means we are really limited in the availability of variables we can use for that. However, for changing these two with the policy instruments compiled by Marek Jarocinski and Peter Karadi, the results do change, obviously, because they are not numerically identical, but they do not change in a qualitative way. Okay, then I think the contribution, the main findings, I will skip, that you have sufficient time to discuss and maybe some questions. Thank you very much.
Okay, I will focus on basically one thing in my discussion. No, you already saw the slides, so you hopefully. Yeah, so the motivation of the paper is the obvious divergence in monetary policy stances across the Fed and the ECB, although that I think has been mitigated a bit after the last ECB meetings. We also heard this yesterday in the panel. And the key question of the paper is whether the Fed monetary policy stance affects how ECB monetary policy transmits to euro area financial markets. And what the paper does is it estimates the effects of ECB monetary policy on euro area financial market variables, conditional on the Fed monetary policy stance in a smooth transition VR framework. It uses high-frequency surprises in ECB and euro area interest rates in order to proxy ECB monetary policy shocks. And it conditions the effects of ECB monetary policy shocks on the Fed monetary policy stance, which is measured as a moving average of Fed high-frequency surprises, or US high-frequency asset price surprises. And what it finds is that the Fed monetary policy stance modulates greatly the effects of ECB monetary policy on euro area financial market variables. But what I take away is that there doesn't seem at this stage at least to emerge a coherent mechanism that gives rise to these nonlinearities. So I think you mentioned portfolio rebalancing in the context of bond yields, and then there is the effect of invoicing in the case of the exchange rate and inflation. But so far there's no coherent mechanism that emerges from the results. Okay, so my comment is essentially on the measurement of the Fed monetary policy stance as a conditioning variable for the effects of ECB monetary policy. And I think in the draft you often refer to the Fed monetary policy stance when, strictly speaking, what you actually use is a record of past Fed surprises. And I think that's not necessarily the same. And one instance is where you refer to this figure and where you say that the central banks both entered the onset of the global financial crisis with a rather tight monetary policy stance, and what I think you refer to is these two blips here, right? So what this shows you here is that the 1 quarter, and correct me if I'm wrong, 1 quarter moving average of the past surprises is positive. And I'm just wondering, why condition on the surprises, even if a moving average? Why not condition on a measure of the overall Fed monetary policy stance? And basically, the reason for this is because we know that the surprises are just they account for a very small share of the evolution of the overall monetary policy stance. I think we need the surprises usually in econometrics because we want to use exogenous variation in monetary policy to gauge its causal effects. And that's why you need to use these ECB surprises. But in case of the Fed monetary policy stance as a conditioning variable, that's not so obvious to me because I think you argue at several instances in the paper that the spillovers from ECB monetary policy to the US and to the Fed stance are limited. If so, then it's not obvious to me why you need to exogenize the Fed monetary policy stance in this exercise. Even if it were not the case, maybe there are other ways to deal with this endogeneity. And I think cumulating or forming a moving average of the Fed surprises is not really different. It's just changes the question the paper is addressing from what's the effect of ECB monetary policy on euro financial markets, conditional on a record of past Fed surprises, not necessarily the Fed stance. And this could, of course, be a genuine research question, but I think it's not what you want to do because you motivate the paper by the observation of this divergence in the monetary policy stances. So this would seem more natural to me to condition on the overall Fed monetary policy stance, and this is what I take from our paper, which is in the appendix, which is reflecting the Fed tightening cycle. You see this here anecdotally dated, and the gray shaded areas, we date them as the Fed tightening cycle. Now we base this, on a combination of anecdotally using the federal funds rate, the shadow rate, the US real policy rate subtracting expected inflation, and the real policy rate gap subtracting a measure of the natural rate. And I think at least that, eyeballing that seems to look fairly intuitive. So why not just condition on the overall Fed policy stance? You could use, for example, also the 5-year Treasury yield in order to account for forward guidance and QE. What could, of course, be is that the sample is too short because you see here, if you start in 2005, they're just 2 tightening cycles, but still maybe there's another way to do it. I have a suggestion at the very end. Here's some minor points. The first one is, if you look at the impulse responses, these are weekly data, and you have weekly impulse responses, the effects die out rather fast. I think already at week 3, or at most week 4, all these euro area financial market variables are back to baseline. And so I wonder, is this a consequence of the priors that you impose, or is this really something that's in the data? Because if it's in the data, what does it imply for ECB monetary policy effectiveness? If you cannot persistently affect any of these financial market variables, be it exchange rates, equity prices, long yields, short-term yields. The second, of course, I understand that the motivation is comparing the Fed and the ECB cycle. But if you really were interested in the role of Fed monetary policy conditioning the effect of another central bank's effects, why not pick the Bank of England, for example? Because it's a much smaller economic area. It's a much smaller central bank. So if anything, I would expect results to speak, or the data to speak more clearly in the case of a very large economy, small economy, country pair. An alternative could even be ECB Bank of England. You could also add this as a robustness check or as an extension. Then another question is, how do you deal with the intra-week timing? The FOMC meetings are earlier in a given week than the ECB. I assume that you don't have a problem because of this, but maybe it's worthwhile to just mention this for the reader. And lastly, this is my suggestion, maybe to also extend this conditioning a bit. You use the Altavilla et al. Monetary policy surprises for the ECB. You have the 4 dimensions, the timing, the asset, the QE, and the forward guidance, and the conventional dimension. And you have the same dimensions, except for the timing, for Swanson shocks. And so why not condition the effect of ECB QE on the Fed stance on QE, and vice versa for forward guidance and the conventional rate? Because at the moment you use the Altavilla surprises and you just average them. And here one question is, do you reproduce the original surprise when you average them, or would you have to weigh them by the loadings in order to get back to the original surprise? Because if you have to weigh them by the loadings and you just take the average, then you're missing out something in the surprises which is unallocated. So basically, this is my comment. I think the major comment is really a why condition on the past record of Fed surprises. Seems more natural to me to condition on the overall stance. And of course, if you do this, then maybe many things change.